For real estate decision makers, there's still time to take advantage of low borrowing costs to strengthen their businesses and property holdings. Leverage the power of artificially suppressed interest rates in this current economic environment that should remain well below rising rates of inflation over the remainder of 2021 and into 2022. Exploit that spread. Hi, my name is Mel Giannone. I'm a commercial real estate broker serving entrepreneurial companies and individual investors seeking property across the Greater Toronto Area. Welcome to CRE Next, Work Out Loud. Here's what happened this week in CRE. What happened to the commercial real estate market in the second quarter of 2021? Hi, this is your GTA market update. Hello, everyone. Welcome back to another latest edition of CRE Next, Work Out Loud. My name is Mel Giannone. I am your host for these episodes that share my everyday work thoughts on real estate out loud with you. I tailor the content for real estate strategists seeking insight into the current commercial real estate market for the Greater Toronto Area. We'll be covering market intelligence, market statistics, and market forecasting. So if you play a real estate role for your company or transact in commercial real estate personally, then I invite you to help grow this online community with me. Let's work out loud together. My intention today is to share with you some important issues, trends, and data affecting commercial real estate in the Greater Toronto Area. The contents for this episode is based on one of our most recent client newsletters that covers current economic conditions and the latest commercial real estate stats for the Greater Toronto Area over the second quarter of 2021. To get a copy of our newsletter called The Prep Sheet, an acronym abbreviating the name of our company, Paramount Real Estate Properties, please subscribe on the homepage of our website at paramountrealestate.ca. If you find any value from our episodes, we welcome your comments, likes, encourage you to subscribe, and tap that notification bell so that you don't miss out on any new content as soon as it's released. Lastly, if you know of anyone who would be interested or can benefit from these episodes, please feel free to share the link with them. You can also find us on other social media channels like Facebook, Instagram, Twitter, and LinkedIn, as well as in audio podcast versions of the show called CRE Next, Work Out Loud. I look forward to connecting with you on these platforms as well. As always, to make sense of it all, we'll break this episode down into two parts by looking at the current macroeconomic picture and then turn our focus on a more micro level as we survey the office, industrial, multifamily, and the investment sectors of our local market. Let's get into it. The Canadian economy, from lagging to leading. While the third wave of infections caused most of the country to lock down during the first quarter of 2021, the less restricted second quarter failed to deliver better economic results as activity stalled in immigration, employment, and housing. While logistic bottlenecks, supply shortages, higher shipping costs, delays in imports, and a surge in commodity and gasoline prices accelerated transitory inflation beyond the Bank of Canada's target 1 to 3% range for CPI. Governor Tiff Macklem of the Bank of Canada has revised the bank's economic outlook for growth back down to 6% for 2021. The remaining slack in the economy, which now sits at about 1.5%, is expected to be completely absorbed by year's end 2022. That's a setback from previous recent forecasts. The silver lining looking forward to the second half of 2021 is that Canada has risen to the top among the world rankings for GDP performance among G7 countries, and first dose vaccinations, now protecting well over 70% of Canadians at the time of producing this episode. Optimistically, the real estate investor confidence has returned as consumption is expected to lead the recovery with the easing of restrictions, allowing for a fully open economy. Households have accumulated a sizable 10% of GDP in excess savings over the last 5 quarters, roughly over $100 billion, which could lead to a spending spree of revenge shopping. Canadian businesses, which also sit on an excess of $130 billion ready to deploy, have set corporate profit records in the first half of 2021, which bodes well for hiring and investment going forward. It is important to note that it would be reasonable to suspect transitory inflation could linger. Up until now, rising costs from supply shortages have contributed to an increasing CPI, but going forward, retail prices will be lifted even further by the demand side of the equation from consumers. Maybe enough to leave a lasting watermark, not a transitory impression on costs for another year or so. For real estate decision makers, there's still time to take advantage of low borrowing costs to strengthen their businesses and property holdings. Leverage the power of artificially suppressed interest rates in this current economic environment that should remain well below rising rates of inflation over the remainder of 2021 and into 2022. Exploit that spread. As of July 16th, Ontario entered into Phase 3 of the Government of Ontario's phased approach to reopening the province. With pandemic health indicators showing steady improvement and public health measures easing, we have some reason for optimism in the commercial real estate market going forward. Statistics Canada had reported that the number of people working from home had decreased dramatically between May and June of 2021 by nearly 400,000. This is good news, especially for the retail sector, which should benefit from the return of employees back to the workplace and public spaces. The migration should generate demand for products and services that will support a broader retail recovery for businesses and the lower income wage group tied to that sector. So that's the big picture. Let's turn to the current market stats for our local GTA market to find out which types of commercial real estate have thrived through the first half of 2021 and where the opportunities might be going forward. The office markets. The preparation begins for the return of employees in September. With a strong momentum in vaccine rollout, sustained reopenings are anticipated. Confidence among office tenants is growing, and the office market is starting to show signs of a bounce back from last year's bottom. The second quarter of 2021 was still defined mostly by sublease activity, short-term renewals and extensions, and a renewed interest for Toronto's downtown core. Over the last quarter, Q2 saw a significant number of inquiries up, office tour visits up, and leasing velocity up. By now, many tenants have completed their internal company surveys to weigh different occupancy strategies for the future, having reevaluated their size needs, settled on hybrid telework schedules, and implemented in-person protocols for visiting. The call to repatriate employees has begun and targeted for September, barring any fourth wave of infections from this still fluid health crisis. The early summer months have already ushered in employees that have spent part of their work week in the office. The volume of sublease listings, which now represents approximately 25% of all available space, has decreased from its peak of over 1/3 of all available space as the flight to quality that characterized these past 6 months saw the best options scooped up by tenants seeking rare opportunities. Many other companies have chosen to rescind their sublistings in favor of repurposing their existing space. Construction completions for 7 new projects across the GTA has delivered an extraordinary level of supply in Q2, totaling approximately 1.8 million square feet, of which over 60% was pre-leased, resulting in a slightly negative net absorption of office space, but not as drastic as in Q1. Most transaction activity took place in Toronto's financial core, where skilled young people are returning to live, and in the GTA West market, where vacancy remains the highest, offering the greatest number of opportunities to score a great deal. Coming off a weak market in Q1, asking net rental rates continue to soften, however less severely in Q2. With landlords remaining flexible towards creative business terms, incentives, and concessions for those tenants with strong covenants. It's time for confident tenants to anchor down long-term leases now, while negotiating leverage still remains in their favor over the next few quarters. The industrial markets, historical lows in availability, record highs in asking rental rates. Toronto's industrial market is by far Canada's largest. It is leading the demand for space and looks to continue its record absorption, with strong leasing in Q2 bringing down the overall availability rate back under 1% in many parts of the GTA. The industrial sector has benefited from sustained demand for consumer goods that require warehousing to support last-mile logistics needs for e-commerce. Vacancy rates keep trending towards new historical lows, which could lead the GTA to run out of large blocks of logistics space before year's end. Average asking rental rates keep pushing up to historical highs, now averaging over the $11 level, which represents more than a 10% rise over last quarter. The highest rents remain north of the city and the cheapest still in the east end of the GTA. Overall availability will remain in the low single digits for 2021 as the demand-supply imbalance continues in the GTA. Approximately 3 million square feet was delivered in Q2, having only 0.1% availability. Options in the GTA will be slim and quickly absorbed, so prepare up to 1 year in advance for a move into larger blocks of space. Otherwise, anticipate a relocation to tertiary markets. Multifamily residential. Rentals in recovery mode, conditions tightening, and prices rise. Some of the rental market trends that have occurred over the past year and a half are starting to revert back to their former pre-COVID levels of performance. Showings are up and vacancies are declining. Rental demand from young professionals, students, immigrants, and non-resident workers shows signs of recovering. With the success of massive vaccination rollouts leading to a reopening of the economy, confidence grows for the multifamily asset class. Demand will rise from low-income earners as jobs increasingly recover. Higher house prices and borrowing costs shift the focus back to rentals. Young professionals leaving their parents' home to move closer to their corporate office, universities planning for in-person classroom learning, and immigrant applications are being approved for many of those already residing in the country. Rental prices in Toronto recorded their first monthly increase in March in 2021 and hasn't let up throughout the late spring and early summer months. Average Toronto rents per square foot across all property types stands at $2.78, representing an overall increase of about 1.5%, or approximately $2,085 a month, with downtown core prices up $200 more. Average GTA rents for high-rise condo and rental apartment buildings are slightly lower at $2,045 a month on average, with one-bedroom condominium apartments up by 3.7% over Q1 and two-bedroom units up by 5.6%. Overall, GTA rental transactions have doubled year over year in Q2, with demand for larger units outpacing studio and one-bedroom apartments, which have higher vacancy rates of up to 5%. Two-bedroom and three-bedroom unit vacancies hover around 2.5%. Price growth is expected to continue, and many landlord incentives offered to new tenants will come off the table soon. Rent payments and occupancy levels held up well, as apartment collections approach 99%, and tenant turnover trending under 8%, which makes this asset class attractive for investors. Commercial real estate investment markets, still about beds, sheds, and redevs. Investment activity throughout the first half of 2021 shows continued strong momentum across beds, multifamily, sheds, industrial, and redevs, redevelopment sites. Growing investor confidence, active lending, and deployment of dry powder capital has encouraged more transaction volume. Overall, Canada-wide capitalization rates have risen slightly to approximately 5% across all asset classes. The spread between these cap rates and the Bank of Canada 10-year benchmark rate, which sits at 1.39% by the end of Q2, continues to range between 300 and 400 basis points. The Bank of Canada will maintain its current monetary policy and has indicated that it will taper its quantitative easing program further by adjusting the pace of net bond purchases down to $2 billion per week. That's down from $3 billion. The tapering should place some more upward pressure on long-term interest rates, while commercial real estate cap rates should continue to compress due to rising prices in the four major food groups: industrial, office, multifamily, and retail. Well, that's all for this episode. Hopefully you found entertainment value in the data presented here, along with the insight into current market conditions, trends, and knowing what the future might look like. My goal here is to help you save or make a lot of money through these episodes of CRE Next Work Out Loud. Please don't forget to sign up for our free client newsletter, The Prep Sheet, found on the homepage of our website. We humbly ask that you like, subscribe, and tap the notification bell so that you don't miss any new content as soon as it's released. If you know anyone who could benefit from these episodes, please share so we can grow our community together. You can also find us on other social media channels like Facebook, Instagram, Twitter, and LinkedIn, as well as in audio podcast versions of the show. I look forward to connecting with you on these platforms as well. Thanks for your time. For real estate opportunities together, I can be reached by telephone at 905-567-5602, by email delivery to mel@paramountrealestate.ca, or communicating through the comments section if you're watching by video or listening via podcast. Until next time, please stay well.